Yeah, Greg, I'm seeing a really interesting question here from Chris. It says, we all think the market will go down in 2021, so is it smart for the funds to be buying?
Interesting. You think the market's going to go down? Where is Chris? Atlanta. So who, by a show of hands, who thinks the prices are going to go down next year in your market? Okay, only a few people. So two things. I'll give you my opinion on it. They have been pushing a little bit high right now. There's been a rush of irrational desperation to get houses. It's driven prices too high. It feels a little bit artificial. And just like everything else in COVID, right? One of the things that characterizes this whole experience is the speed with which everything is happening, right? I mean, we had a recession that started on a Tuesday, and by like Thursday, unemployment tripled, right? Like the stock market crashes, and the unemployment triples the next day, and then the recovery, like it was insane. In fact, we actually talked a lot about this back in March and April about the idea that some of you remember that I wrote a book back in the day. Got one hanging right here collecting dust. Crash Boom. Crash Boom was written in 2009, and it was all about the idea that one comes and the other comes after it, especially in real estate, right? And the cycles that I researched here were basically the Great Depression. And the big takeaway was that the crash and the boom are two chapters in the same story. They're related, they're not disconnected. So when you have a recession and you have a recovery, they are twins, right? They're related to each other. And the big question that I had coming into COVID, because as chief strategy officer, I assumed that part of my responsibility here was to try to think about what the scenarios might be. As a company, we were all focused on what if? What if half of our tenants don't pay their rent, right? What if unemployment goes to 40%? What if 2 million people die, right? What does this mean for our employees and for the business? These are questions that every one of us was asking at one level or another 8 months ago. And so the scenarios were just rolling in our heads. And I went back to the research that I got from here, because now I had the Great Depression for the book and the experience of the Great Recession to draw on, and what happened in 2001. Also, the 9/11 tech stock bubble, 9/11 experience. And the big takeaway was, in fact, that these two things were connected. And if the severity and the pace of the recession is matched by the severity and the pace of the recovery, what's that going to look like? And the way these things always seem to happen is something takes place, some economic occurrence happens, and then human beings respond, right? Stock market takes a dive in 2008, takes a dive in 1929, takes a dive in 1999, takes a dive in 2020. Something happens and then people sell their stocks. I'll put it that way, okay? So the occurrence is the beginning of it. The stock market crashing is usually the first indication that human beings are having a reaction. They're dumping their stock in a cold sweat. So the stock market plummets. Then a little bit of time passes and consumer confidence begins to erode slowly or rapidly, but people start losing confidence, okay? They stop spending money. They start hoarding their money. They don't want to go for that new car. They don't want to go for that new house. They basically pull back on the spending. And so consumer confidence erodes, and then businesses start to notice less people on the website, less people in the stores. Forget COVID, right? Just the way these recessions happen is that there's an occurrence, there's a human reaction, which creates another occurrence, another human reaction. It's a chain reaction of people doing things and then the economy responding, or the impact of their actions on the economy, then the next action, the next action. Usually stock market, consumer confidence, business confidence, as businesses start laying people off, they stop hiring, then they begin laying people off. Then the real estate market, usually as the slower, more lumbering market, has its reaction. And the home buyers stop buying, the home sellers stay stubborn until finally they buckle and the home prices begin to go down. That usually happens 18 months later. But this time, COVID, 2 days later, stock market plummets. 4 days later, unemployment triples. And then like a month and a half later, the stock market rebounds and the stimulus happens. And then people all of a sudden in most sectors in the country realize that it's not as bad as they were afraid. And then consumer spending loosens up again. And then the real estate industry, by a show of hands, whose real estate company had the biggest months in company history in June and July? Yeah, a lot of you. A lot of my friends in the industry, that's exactly what happened. A lot of home builders that we know had their biggest months. Home builders were freaking out back in March and April. They thought that their machine was going to stop. Then they sold every house they had planned for the year in a 2-month window. It's unbelievable, right? So what was crazy about this is that this all happened so quickly that the housing market essentially sat it out, right? Like it went down, and then the V-shaped recovery happened in other parts of the economy, and real estate was just getting ready to respond. And then all of a sudden we had a real estate boom in the middle of this, no bust, just this little pause for 2 months. So the spring market of 2020 didn't happen, or maybe it did. It happened in the summer. So the summer market and the fall market was the spring market on top of what was going to be the summer and fall market. It's insane, right? So based on all that, if that trend continues, Chris, what I think is possible, and personally I think likely, is that this extreme seller's market could very easily become a more even-handed market as soon as this winter and spring, for no other reason but the fact that everything about this has been shockingly fast. All right. So right now we're in an extreme seller's market. We should, by rights, be hanging in there all the way through 2021, but yet nothing takes normal time in this particular experience. Vaccines apparently are coming out. I'm a believer that when the election is finally over, one way or the other, that to whatever extent COVID's been a tool in this election, that's going to stop. And so when the first vaccines get shipped, which might be before the end of the year, it's going to change people's mindsets dramatically. And the mad exodus out of the cities is going to ease up. People buying houses sight unseen. Some people saw that, I'm sure, right? That's going to ease up. To answer your question, I don't think prices are going to go down. I think demand is still going to be there. They might flatten out, though. There may be some places in your area that have seen insane jumps in prices. And it's going to be one, instead of being a correction like this, where it then goes down and goes up, it's going to be like this, boom, 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 and back again. It's going to happen so quick, we're almost going to miss it. So it might be, instead of a year-long correction, it might be a 6-week correction. And then the spring market of 2021, we hope, is going to be like a normal, fairly even-handed market, probably still a seller's market, but not one where the buyers are scratching each other's eyes out to get houses and paying over asking price.